Every time the Federal Reserve talks about cutting interest rates, the stock market reacts. Sometimes it rallies, sometimes it crashes. So the real question is, what actually happens to the stock market once interest rates fall? And more importantly, how should investors think about it? Well, let's find out.
So the Federal Reserve has now cut rates again, third meeting in a row at
It will be appropriate to cut rates at such time as inflation is coming down.
The Fed cut its key interest rate today.
Federal Reserve today as they cut the benchmark interest rate.
To make it simple, interest rates are essentially the cost of money. When interest rates are high, borrowing is more expensive. When interest rates are low, borrowing is more cheaper. And this goes for the government, this goes for consumers, this also goes for businesses. And because stock represents ownership within a business, well, as interest rates begin to drop, you can see how this can easily affect a company's growth, which directly affects the stock price. So like in the short term, falling interest rates are usually good for stocks. A couple of different reasons. One, you have lower borrowing costs. You have things like higher profit margins, easier expansion, and increased consumer spending. Now this is why you oftentimes see markets rally before the rate cuts actually even occur. Markets are just forward looking. But here's the caveat. Here's the part that people often miss. Why interest rates are falling are oftentimes more important than the actual rate cut itself. So let's look at two very different scenarios here. Scenario one, rate cuts during economic strength. Now, if rates fall because inflation is under control and the economy is doing pretty well, stocks tend to perform very well. And the typical winners of these include small caps, tech stocks, growth stocks, and real estate. And the reason for that is lower interest rates increase the present value for future earnings for stocks that are expected to grow over time. Then we have scenario two, rate cuts during economic trouble. Now, if we do start cutting rates due to things like the economy slowing or fears of recession, well, the market can react very differently. There's a couple different reasons. The biggest probably being that investors just typically prefer safety. Unfortunately, earnings decline outweighs cheaper money. This is why rate cuts doesn't always automatically mean stocks go straight up.
Interest rate policy, if they cut rates in a subsequent meeting, that could be pretty positive for equities, and I think they've really been responding to that.
Now, not all stocks respond the exact same way to falling rates. There are certain sectors that perform better than others. One being growth in tech. This is a sector that's heavily dependent upon future earnings, and they benefit greatly out of cheaper financing. There's also the sector of real estate and REITs. Typically, we see lower mortgage rates, which creates more demand for mortgages. There's also the sector of consumer discretionary spending. This includes things like cars, travel, retail, and that's because typically consumers spend more when they're able to borrow more. So then there's the question of who actually struggles. Well, typically sectors like banking, lenders, they typically struggle, and that's typically because they see compressed margins. These are very cash-heavy dependent businesses, and typically these are low-growth businesses. One of the biggest clues come from the bond market. Typically when rates drop, the bond market rises. Reason for that is, say hypothetically you are holding a bond at say 5%. Now new bonds are going out for 3%. Well, to a new investor, that 5% looks a lot more attractive than that 3%, which typically is why we see a demand in the bond market. Now, with that being said, when bonds rally aggressively, that typically signals caution, not optimism.
No.
Now, for long-term investors, rate cut cycles are mostly just noise. They're not a reason to panic. 3 key principles I want you to take away. 1, the market prices in rate cuts early. 2, timing rate cut decisions is very hard to do, almost impossible. 3, asset allocations matter more than predictions. The goal isn't to guess the Fed. The goal is to build a portfolio that's able to survive in every rate environment. So in conclusion, when interest rates go down, stocks can benefit, but only in the right context. The most important question isn't, are rates going to fall? It's, why are rates falling? And if you understand that, then you're already ahead of most investors.
Now, if this video gave you any clarity in regards to the stock market, or if you just enjoyed the video, make sure you like and subscribe. And I'll see you all in the next one.